R.B.I. Governor about to start speaking. Let's get across.
All of you, and welcome to this conference. I thought the world will end on 21st December, as the Mayans said. And as the physicists say, we'll go into a Big Bang collapse and the R.B.I. will disappear with high inflation record. That did not happen. So we are into relentless pursuit of higher growth and lower inflation. And in that pursuit, we reduced the repo rate this morning from 8% to 7.75%, and also cut the CRR from 4.25% to 4% of NDTL. That is also, as many of you may have noted, historically the lowest number. Indeed, 4.25% itself was the lowest number. We did both actions, both the rate action as well as the CRR action, in order to ensure that there is a transmission of monetary policy into lending rates. As we explained in the policy document, this was informed by three considerations. There was the consideration of inflation having moderated, both headline and core inflation. And also the momentum of inflation, the 3-month seasonally adjusted moving average annualized inflation. That also shows that the momentum of inflation is coming down. Then on growth, we've had deceleration of growth, not just of investment, but also of net exports. Also, they were declining for some time, but now also of consumption demand. The third consideration that weighed with us was liquidity. That was quite tight over the last few months. Those of you who have been keeping tabs would have noted that because of the CRR cut in September and October, we pumped in liquidity of 350 billion rupees. And today's CRR cut would pump in another 180 billion rupees, that's 530 billion. We also did OMOs in December and January, or November and December. December of 470 billion rupees. So just add them up, it adds to a neat 1 trillion rupees. We didn't do it to get a round number, but that's how it happened. 350 billion because of CRR cuts in September and October, 180 billion because of today's cut, and 470 billion rupees because of the OMO operations. There were still average lab drawings during the month of January of 910 billion rupees on the average. That suggested that there was a structural liquidity deficit, and that prompted the CRR decision in addition to the rate action. We, of course, discussed the global outlook and the domestic outlook. I will not go so much into the global outlook because that's quite clear. But only message on the global side is that global economic prospects have improved modestly since our last review, even though there are significant risks that persist. On the domestic economy side, growth decelerated. The first quarter was 5.5%, second quarter was 5.3%. Taking into account the development since the last quarterly policy review, we revised our growth projection downwards from 5.8% to 5.5%. You will note that in the first half of the year, growth was 5.4%. So in order to achieve 5.5% for the full year, in the second half, the average growth has to be 5.6%. So our expectation is that growth has bottomed out for a number of reasons that I could explain to you should there be a question. Inflation also, we scaled down the projected estimate for March 2013 from 7.5% to 6.8%. And I will get into that in a slightly more detail shortly. There were 5 risk factors that we indicated. The first was the twin deficit risk arising from a high current account deficit and large fiscal deficits. The second risk factor stems from the global outlook and what global risk perceptions, the implications of that for financing our current account deficit. The third risk factor relates to the inflation outlook, and in particular we mentioned that even as demand pressures have ebbed, sustained reduction in inflation will have to come from vigorous supply response. The fourth risk factor is about investment, which is very, very important because the key to stimulating growth is a vigorous and sustained revival in investment. And achieving this will depend on a number of factors, including bridging infrastructure gaps and resolute pursuit of structural reforms. Finally, we also mentioned the bank asset quality. Banks, and indeed the Reserve Bank, were quite understandably concerned about the high level of non-performing assets, but we were also concerned that the high NPA level should not cut into the flow of credit to productive sectors of the economy. That's as far as the policy document summary goes. Your standard question has always been about the guidance. As I told you several times before, we agonize quite a bit about the English that goes into it and the communication value of that, and this time has been no exception. But I thought I would voluntarily interpret the guidance for you before you ask me a question. One sentence there which says that the decline in inflation provides space, albeit limited, for monetary policy to give greater emphasis to growth risks. So, what does that imply? Our decision to cut the rate and cut the CRR rate also was informed, as I told you, by inflation coming down and growth moderating. Growth is actually below trend and there is a negative output gap. If you look at inflation, headline inflation has moderated. Core inflation has come just above 4%. Momentum indicators, as I've told you, have come down. CPI inflation too, which is high, but if you knock out food, that's level. It's at 8%. So CPI inflation, as much as it is a matter of concern, but if you try to disaggregate that and knock out food, you find that it's at a level. So the trends in growth and inflation made a persuasive case for easing monetary policy. However, there are upside risks to inflation, and I want to spend a couple of minutes giving you that. The first risk is about food inflation. Both in WPI and CPI, food inflation has been high, and that can put upward pressure on inflation expectations, and there will be pressure on monetary policy to respond, and indeed there is obligation for monetary policy to respond to entrenched inflation expectations. The second risk comes from the monthly diesel price increase, which is a good thing for long-term inflation management, but in the short term it will put inflation pressures and thereby have implications for inflation expectations. The third is global crude prices. They have plateaued in the last couple of months. Some people say that they should have come down even more. So the fact that they have plateaued at this level shows that there are some upward pressures. Crude oil prices going forward will depend on both economic, financial and geopolitical factors. And as far as we are concerned, the rupee price will also depend on the exchange rate movement. The fourth risk factor to inflation is suppressed inflation. From last year, if you recall, coal price was adjusted in the month of January. So that gave us a benign base effect for the first or the last quarter of this fiscal year, the first quarter of the calendar year. We expect that coal prices will be adjusted later this year, perhaps in April. There will be a consequent adjustment in electricity prices. Some of the suppressed inflation must come out. It will come out, and that will put inflation pressures. Finally, there is the pressure from wages. In the MMD document released yesterday, we indicated that rural wages continue to be going up. They went up as high as 22%, but this last year, inflation in rural wages was 18%. What is of concern is that that increase in wages by 18% in nominal terms, by about 7 to 8% in real terms, is not accompanied by any productivity improvement. Therefore, there is inflation pressure. By far the biggest risk for inflation and for macroeconomic management is the current account deficit. Not just a high current account deficit, but a high current account deficit in the context of slowing growth and high fiscal deficit. For the first half, CAD was 4.7%. The third quarter trade numbers are quite disturbing, and the current account deficit will also be quite high for the third quarter. Why is that a problem? That's a problem because it has implications for financing the current account deficit. It has implications for our exchange rate stability. And especially because it's happening in the context of slowing growth, our ability to attract capital flows can get affected if growth slows down. And then in the context of a large fiscal deficit, there is this vicious cycle between large fiscal deficits feeding into large current account deficits and so on and on. There is also another concern about CAD which is not so much discussed, which is the quality of CAD. If we had a high current account deficit because we were importing capital goods, that was okay. But if you're having a high current account deficit, because we're importing a lot of diesel, and which is not where demand is not price elastic, and if we're importing a lot of gold, that is a concern. We had discussed about the implications of easing monetary policy when we expect CAD to be going up. The normal expectation, the textbook, is that if you expect the CAD to be going up, you would want to tighten policy. Easing will lead to increase in aggregate demand, perhaps increase in exports, therefore worsen CAD. There is also the concern about how this might be interpreted by our external analysts, external interlocutors, and external financiers about how easing of monetary policy in the context of rising CAD might be interpreted. And what indeed it might do for flows are our flows, equity flows, debt flows, and how interest sensitive they are. We have taken into account all this, including the implication of easing policy at a time of rising CAD, but taking an overall picture, balancing all considerations, we decided to ease the policy rate. So what does all this mean for the monetary policy stance? I started from guidance and interpreting the guidance. So what it means is that if inflation eases further I mean more than we expect it to, and if CAD moderates further, by further I mean more than we expect it to, because in the fourth quarter, CAD might be less than in the third quarter, but it has to be significantly less, and we have to have low and sustainable CAD. So if inflation moderates further, CAD moderates further, there will be more room for monetary policy easing. But if they go along the currently expected lines, the space for monetary policy easing is quite limited. I'm taking a little longer than usual, but please bear with me. I also want to tell you a few things about what we discussed with banks this morning. You interviewed the banks yourselves. As far as monetary policy transmission is concerned, banks were more forthcoming than before, and that they were more assuring than before about the transmission taking place. through lending rates. On deposit rates, the signal was not uniform. Some banks thought that deposit rates might come down. Some thought that there was not so much room for deposit rates to come down. They also expressed concern that savings are fleeing. There's a flight of savings to the non-bank space, and also substitution of savings in the bank by purchase of gold. Some banks also said that their margins will come under pressure, but overall the message we got was that monetary policy transmission will take place. They were more assuring about transmission taking place because we had also cut the CRR. We discussed quite a lot internally about whether we should also accompany the rate cut with a CRR cut. And the consensus, or not the consensus, but at least the decision after extensive consultations was that in order for monetary policy transmission to take place, we must also do a CRR cut. The liquidity constraint is not uniform across banks. Some banks have constraints, some banks are relatively more comfortable. So we gave a message to the banks that accessing the MSF is not a stigma. There was some apprehension within the Reserve Bank that perhaps some banks think that the regulator will look askance at the bank accessing the MSF. So we made it quite clear to them that that would be a reasonable, appropriate, and right thing to do if they have a liquidity constraint. There was discussion on export performance and bank credit for exports. Those of you who have been following would have noted that we did two things in the last 6 months. We expanded the rupee export refinance facility from 15% to 50%. Just 2 weeks ago, we also introduced the dollar-rupee swap facility up to $6.5 billion. I believe banks are mandated to extend up to 12% for exports, but the aggregate level of export finance is 5% or even lower. There are, apart from the cost of financing for exports, there are a number of other non-cash issues, such as transaction costs, accounting norms, documentation required, procedural difficulties, etc. After consulting the banks this morning, we decided to constitute a technical working group under Mr. Padmanabhan, our Executive Director, to go into these issues. This working group will involve, apart from the R.B.I, Exim Bank, ECGC, FIO, FIMDA, and IBA. We also talked about transition to risk-based supervision with banks. Some of you, if not all of you, may have seen the Chakravarti Committee report, which said that consequent to our transiting to Basel III, banks must also improve their risk management systems and practices. There were several things that were identified as needing to be done, like capacity building, like better quality data, introduction of systems and processes within the Reserve Bank and within the banks. The impression or the message we got was that different banks are at different levels of preparedness for transiting to risk-based supervision. There is not much of a difference between private banks and public sector banks, but there is difference across banks altogether. There were some questions about whether the Reserve Bank is going to be very prescriptive on what risk-based supervision is, but what Mr. Chakravarti told them was that it will be principle-based, not very prescriptive, but we need to disseminate much more information for that purpose. There will be a major conference in the next 1 month with the CEOs on risk-based supervision. The final thing we talked about with banks was about infrastructure bonds, inflation-indexed bonds, inflation-indexed bonds. We introduced that some years ago, and that didn't take off because of some design flaws. Since then, based on the lessons that we've learned, we've tried to redesign it, this time, most importantly, indexing both the principal and the coupon to the inflation rate. We consulted banks about whether this might be successful. There were several questions apart from the design about which inflation index do we peg it to, CPI, WPI, and if we peg it to CPI, which is about 10%, what interest rate do you offer? Whether that will attract retail investors, indeed even bulk investors. Then about timing, can you do it at a time when inflation is rising? The government will want to do it when inflation is falling, but customers will want it when inflation is rising, so there is an inherent conflict there. They've also said that we must introduce it at a time when there is no tax-free bonds in the market, so that there is no rivalry for this. One question that haunts us all the time is whether this will disrupt.
Okay, that's Governor Subbarao with his comments.